So the stock market is still the easiest way to get rich. Now, it might not be the fastest, but if you think about it, investing in the stock market, you can still build and maintain your wealth. You can create a passive income stream, and you can also invest for your retirement because you don't, of course, want to work your whole life. If you look at some of the billionaires that we know in today's day and age, billionaires such as Warren Buffett, Armencio Ortega, Carlos Slim, even Bill Gates, they all have a good chunk of their wealth invested in the stock market. And they're pretty much just living off the proceeds and the dividends that they get from their investments. Some of the companies that they invest in are companies such as Apple, Microsoft, Coca Cola. These are companies that you and myself have access to invest in also because these are publicly traded companies. If you think about Warren Buffett, he made all of his billions from investing in the stock market. It did not come from real estate, it did not come from crypto, it literally just came from investing in the stock market. That's why today I want to talk about the 4 different ways that you can make money by investing in the stock market. And at the end, I'll also have a bonus, another way that you can make some passive income with investments that you already own. So some of the benefits of investing in the stock market is that, first of all, it's extremely easy to get started investing in the stock market. It's even easier than getting into real estate or even starting your own business because all you need is a brokerage account or an investment account and some money deposited in that account in order to get started. Now, you don't even need that much money in your brokerage account because you don't have to buy a whole share or a bunch of stocks. You can literally buy a fraction of a share. So you don't need a lot of money. Another benefit also is that you can invest anywhere in the world as long as you have an internet connection and you have access to your brokerage account or investment account. So you can have your phone with you, you can be on vacation, and as long as you can log into your brokerage account and you have that internet connection, of course, you can buy and sell securities in the form of stocks, of course. Now, another benefit is that you are your own boss. So this might be a good thing, this might be a bad thing, but for most of us, it's going to be a good thing. You can decide what your investing style is. So if you're the type of investor that's more on the day trading side, so buying and selling at a frequent basis, or you're more of an investor that likes to go after growth stocks, so stocks in the tech sector, or you're more of a value investor, a buy and hold investor, you can decide what type of investor you are. So you have control over your future. And then the last benefit, of course, also is that you have a couple of bragging rights also. If you're the type of investor that likes to invest in individual companies, just like myself, let's say you bought Apple on Monday, and then a week later, the next Monday, Apple went up by 10% over that course of a week. You can go to your friends or family members and start bragging to them about, okay, look at my Apple stock. It just went up by 10%. You have that bragging right that, will make them a little bit jealous. They might look at you and you ask them like, okay, what did you do the whole week? Well, I just went to work, of course. So you also have some bragging rights, and people will start asking you questions if they see that you're doing pretty well with your investments. The first method to make money in the stock market is through capital gains. Now, the easiest one to understand is buy low, sell high. So you buy a stock at a specific price and you sell it at a higher price, and the difference is your profit. Now, a stock, of course, represents ownership. So whenever you're buying a stock, you own a piece of the company that you just bought. You're a shareholder or you're a stockholder. Now, those two words, shares and stocks, when I first got introduced to the investing world, I had to figure out, okay, why are those being used interchangeably? Because there is a difference. A share is a single unit. A stock could be a single unit, or it could also be multiple units. So you would say, I own 1 share in Coke, or I own 10 shares in Procter & Gamble. Or you could also say, I own stock in Coca-Cola and I own stock in Procter & Gamble. So the best way to remember this is that you own shares of stock in a specific company. Now, going back to capital gains, buy low, sell high. Let's say I bought Coke, 1 Coke share at $55. A week later, it goes up to $60. I sell it. I just made a profit of $5. It went from $55 to $60. I sell it. The difference, $5, that's my profit. Now, when it comes to capital gains, because the word capital gain is you buy the Coke at 55 bucks, it went up to 60 bucks. My capital gained in value. It went from 55 to 60. So I have a capital gain of $5. My capital gain is still something called unrealized if it's still trading in the market. Because when your investments are still in the stock market, they have the potential to go up, down, or sideways. Your capital gain, which is unrealized, becomes a realized capital gain when you sell your stock. So once your Coke goes from 55 to 60, it's still an unrealized gain because it's still in trading in the market. I sell it at 60, it becomes a realized gain. The second method of making money in the stock market is through short selling or selling short. Now, this is the opposite of buy low, sell high, and this is more of a riskier technique. It's more of an advanced technique. Buy low, sell high, the opposite. With short selling, you're selling high and buying low, and the difference is your profit. Let me explain with an example that's outside of the stock market, then I'll bring it back to the stock market. So let's say you have a friend, one of your best friends, he just bought a PlayStation and he's playing the video games on it. He enjoys it, he talks to you about it, and you tell him, you know what? I'm interested also. Let me go ahead and borrow your PlayStation. So he lends his PlayStation to you, and you're a horrible friend because you needed some money and you end up selling his PlayStation for 500 bucks. A day or two later, your friend comes up to you and he talks to you about the PlayStation and the games. He asks you, oh, how is everything going with the games? And you're telling him like, oh, it's perfect. I love the PlayStation. I love the games. I'm thinking about buying my own. He tells you, okay, cool. I still want to go ahead and play my games, so can you bring back the PlayStation before the end of the week? Now you start to panic because you already sold the PlayStation and you're scrambling around. You're going to different stores and you happen to go to one store that sells new PlayStations at 200 bucks. You're like, perfect, because I sold it for 500 bucks, I can buy it for 200. So you buy a new PlayStation for 200 bucks, you give it to your friend, and you just made a profit of 300 bucks. So you sold it at a high price of 500 bucks, you bought it back at 200 bucks, the difference, 300 bucks, that's your profit. Bringing that to the stock market, now your brokerage account will potentially charge you some fees, of course, and they will borrow those shares from investors that are with the company or even investors that are outside of the company. Now, the tricky thing about selling short, because this, of course, is a risky method of making money in the stock market, at least with buy low, sell high, the only money that you can lose is the money that you've invested into the stock market. So let's say you invested 500 bucks into the stock market, one company, and that company ends up going bankrupt. You only out that 500 bucks that you invested. But with short selling, your losses could be unlimited. So for example, let's say you were participating in short selling and you did a short sale on Coca-Cola. Coca-Cola was trading at 55 bucks. You think that Coca-Cola is going to drop to 40 bucks, so you can buy it back and make that profit. That between 40 and 55, that's the profit that you're making, at 15 bucks. But what actually ends up happening is that instead of Coca-Cola going down, the price actually goes up. So from 55, it's not going to 40, it's actually going to 60, 70, 80, 90. So as you can see, your losses are going to be unlimited because you still have to buy it back. The third way to make money in the stock market is through dividends. And this is more of a passive income method of making money. Companies, not all companies, but a lot of blue chip companies that are well established, they might pay out a dividend. Companies sell goods and services, and a portion of their profits, a portion of that net income, is distributed to their shareholders in the form of a dividend. This is also one of my favorite ways of making money in the stock market. And I have my own rules on analyzing specific companies to see how they pay their dividend and if they're increasing the dividend, because something that's extremely important to me is that companies that do pay a dividend, they need to be consistent with the dividends that they pay, and the dividend payment needs to grow faster than inflation year over year. That's a requirement that I have for these companies. So the fourth method to make money in the stock market is through options trading. Now, options trading can get a little bit confusing, but I'm going to try to keep it simple and explain it in a way that's simple to understand by talking about the call option method. Let's say you own 100 shares of stock in Coke. You bought Coke for 55 bucks. You're making money from Coke because Coke pays a dividend. They pay a dividend every quarter. So every quarter you're getting dividend checks, you're getting dividend payments. But you're not satisfied. You want to make even more money from your shares of stock in Coke. So what you end up doing is you end up writing an options contract. You end up writing a contract. So in that contract, you're pretty much saying that I'm willing to sell my 100 shares in Coke at 60 bucks. 60 bucks, also called the strike price. The reason why I say 100 shares of stock is because an options contract is usually a lot of 100 shares. Now, if the buyer of this option contract agrees with my contract, he has to pay me a premium. Now, a premium might be $1 per share on this options contract for Coke, for my 100 shares in Coke. Now, the premium could be influenced by a multitude of things. If the options contract is for a stock that is popular, it's gonna have an impact on the value of the premium. The closer the actual price of the stock is to the strike price, that means that the premium is usually gonna be higher. But let's stick with $1 for one share in Coke, and an options contract, it's a lot of 100, so we're getting a premium of 100 bucks directly deposited into our brokerage account. So let's talk about how the seller is making money then. So I'm the seller in this case. If Coke, which I bought for 55 bucks, never went up to the strike price, which is 65, more than likely the buyer is not going to execute the options trade, because why buy Coke at 65 when it's trading below 65? So I just made some additional money without even selling my shares in Coke, because I still own the shares and I made a quick 100 bucks. Now, even if the options contract did get executed, I would still make some money, because let's say I bought it at 55 and then the stock went up to 60 and it went past 60. The options contract gets executed and the buyer buys my 100 shares at 60 bucks. I still made a profit of 500 bucks plus the additional 100 bucks, because I bought it at 55, it went up to 60, so that's a $5 increase. I own 100 shares in Coke, so 5 times 100, I made a profit of 500 bucks plus the premium, the $100 premium. So I just made a profit of 600 bucks. From the buyer side, I'm already $100 short. I'm already $100 in the hole, because I had to pay that as a premium to the seller. Now, if Coke never goes up to 60, I'm not gonna execute that options trade, because why buy Coke at 60 when it's trading under 60? But here's the cool thing. If Coke goes up from 55 to 60, I execute the trade and it ends up going to 65. Now I just potentially made $400 in profit, because let's look at this. So Coke went from 55 to 60. I execute the trade as the buyer, and then it goes from 60 to 65. Now I just made a $5 profit per share and I own 100 shares. So that's 500 bucks. It's still unrealized, of course, so I end up selling at 65. Now I just made a quick profit of 400 bucks. Why? Because that 500 bucks minus the premium of 100 bucks gives me that $400 in profit. That's pretty much how you want to look at options trading simplified. And the bonus method that I want to mention when it comes to making some additional income with the stocks that you already own, and this is a passive income method, and you can already make some passive income by investing in dividend paying stocks. But with this method is called stock lending. So you can lend out the stocks that you own for example, short selling. Now, you do want to be careful with this method, because if you own stocks that do pay a dividend, you want to make sure that you will still get the dividend payment if you're lending out your stock. Every brokerage firm is a little bit different, so definitely double check with your brokerage firm and make sure that you aren't taxed in a different manner when it comes to this, because I've noticed that with Robinhood, you can do stock lending because there are some differences between those two brokerage firms and how they go about stock lending. So definitely make sure that you double check the fine print on stock lending. Now, this will not make you a millionaire, of course, but it is a quick way to make some additional passive income. Now, if you like this topic on how to make money in the stock market, then definitely check out some of my other content on the stock market and even passive income in general.